The home improvement store Lowe's has been killing it lately. Their share price has gone through the roof. Is it time to buy in? Stick around to find out. Hey everyone, Stock Ninja here. This is episode 16 of Who Beat the S&P 500. Today we're going to be looking into Lowe's Companies Incorporated, otherwise more commonly known as just Lowe's. Stick around till the end of the video to see what I currently own in the consumer cyclical sector and my plan with Lowe's stock. Without further ado, let's get right into it. Quickly approaching their 100-year anniversary, Lowe's was founded in 1921 in North Carolina by Lucius Smith Lowe. The company went public in 1961 before it began trading officially on the New York Stock Exchange in 1979. With operations in the United States and Canada, today Lowe's is the second largest hardware chain in the United States behind rival Home Depot. Lowe's currently operates over 2,220 improvement and hardware stores. Let's see how much money you could have made had you invested in their stock over the last 20 years. Had you invested $10,000 into Lowe's exactly 20 years ago, with dividends reinvested, you would have an exceptional total of $177,785.67 versus the $32,086.72 of the S&P. That's a 1,676.36% total return, handily beating returns of the S&P's 221.13% by nearly 8 times, which comes out to an average annual return of 15.47% versus the 6% of the S&P in the same time frame. Lowe's steadily marching higher and leaving the S&P well behind. As always, if you're enjoying the content, don't forget to hit that like button and subscribe to the channel. Also, hit that bell notification so you don't miss out on any new videos. Lowe's currently has a market cap of nearly $120 billion, making it one of the largest companies within the consumer cyclical sector. Lowe's currently trades with the ticker symbol LOW and is listed as a member of the S&P 100 and S&P 500 component indexes. Distributing their dividend quarterly, Lowe's currently has a relatively low dividend yield of 1.39%, which comes out to an annual payout of $2.20 at a very low payout ratio of 26.90%. So a lot of breathing room for them to pay the dividend each year, and when looking at the dividend safety score from Simply Safe Dividend, we can see an excellent 93 out of 99, which is considered to be very safe. I was expecting it to be a bit higher, but still anything in the 90s is fantastic. When looking at the dividend growth, this is where Lowe's really shines. Lowe's has been growing their dividend for 56 years straight, making them a dividend king. A very exclusive list of just 30 companies that have grown their dividends consecutively for 50 years or more. On top of that, their 10-year CAGR is amazing at a double-digit 19.39%, and given their low payout ratio along with their recent success, I see no reason for this number to slow down. Lowe's is an excellent stock for any dividend portfolio. Though their dividends won't be huge, the key is their dividend growth. Lowe's fiscal year runs from February through January each year. We will take a look at their most completed annual report, which is fiscal year 2020. In fiscal year 2020, Lowe's generated approximately $72.15 billion in revenue. And when we look back the last 4 years, we can see revenue growth each year, although it appears to be slowing down, with over 10% growth in revenue from 2016 to 2017 to just 1.18% growth from 2019 to 2020. Also, Lowe's balance sheet is looking much stronger than it did just last quarter, with current assets growing nearly $6 billion, whereas current liabilities grew around $3 billion, and seems to be in good shape to cover short-term liabilities. Lowe's currently has a PE ratio of 27.24 and a forward PE ratio of 23.64, indicating revenue should continue to grow. Now let's see how Lowe's breaks down their income by operating segment. Lowe's has just one reportable segment, which they call Home Improvement Retail Operations. So what exactly does this operation segment encompass? According to their 2020 fact sheet, Lowe's offers a complete line of products for maintenance, repair, remodeling, and decorating throughout the following categories: appliances, decor, flooring, hardware, paint, tools, and many more. A typical store stocks approximately 35,000 items, with hundreds of thousands of additional items available through online purchase. They serve their customers through what they call the omni-channel retailing, which is made up of their in-store operations, online operations, on-site customer support, as well as call centers for customer support. Another important aspect to note is their supply chain, which consists of regional distribution centers, which are 15 highly automated facilities in the United States used to efficiently and effectively move products from vendors to stores. They currently own and operate 7 distribution centers, including 4 lumber yards. Lastly, one thing to note is that since the new management took over in 2018, Lowe's has been aggressively closing down many underperforming stores, including all of their Orchard stores, some Lowe's stores in the United States and Canada, and all of their operations in Mexico. Now, let's see how the company fared in the dot-com bubble crash, the Great Financial Recession, and how it's currently trading in the downturn in 2020. Lowe's fell 49.20% during the dot-com bubble crash, falling just under 1% less than the S&P's 50.41% decline. Lowe's stock doing marginally better than the S&P during the dot-com bubble crash. During the Great Financial Crisis, Lowe's fell 63.65%, performing about 7% worse than the 57.61% decline by the S&P. The S&P faring better than Lowe's during the Great Financial Crisis. During the downturn in 2020, Lowe's fell 52.59%, compared to the S&P's roughly 35.59% decline. By far the worst performance in terms of overall drawdowns during a recession by Lowe's compared to the S&P, but that does not tell the whole story in 2020. When looking at the performance of the company since that March low, Lowe's has been on an absolute tear. The company is up nearly 169% from the bottom earlier this year and is one of the best performing stocks in the consumer cyclical sector this year. Headquartered in Mooresville, North Carolina with around 300,000 full-time employees, Lowe's is currently led by CEO Marvin Ellison. Ellison has been leading the company since July of 2018, shortly after former CEO Robert Niblock retired. One thing to note is that Ellison was previously the chairman and CEO of JCPenney before he came over to Lowe's, and during his tenure there, he squeezed every dollar he could in savings. When he left JCPenney, the company was in a much stronger financial situation than when he first joined, though ultimately JCPenney still filed for Chapter 11 bankruptcy earlier this year. Ellison leads an executive leadership team of 9 members, as well as a senior leadership team of 20 members. Now, what is interesting about the management is that Ellison has done a massive restructuring of executives and senior management since he has taken over. I was hard pressed to find more than a handful of people from the 29 members that was at Lowe's longer than 10 years, with the majority of them joining in 2018, the same time that Ellison took over. This could be a good thing, but typically, I like to see some veterans who know the business and management. That being said, Ellison has a lot of industry experience, so he probably knows what he's doing. Let's see how Lowe's performed under the last 2 CEOs, given that Ellison has only been at the job for about 2 years. Under former CEO Niblock, who led the company from January 2005 through July of 2018. Lowe's rose an excellent 249%, posting very solid growth numbers in that time frame. Meanwhile, under Ellison, the company has risen 62.5% since he has taken over, which is very nice given how much of a drawdown Lowe's had earlier this year. Let's see which institutions have the most Lowe's stock. Starting with 5th place, we have Bank of America with a 1.84% stake in Lowe's. Next in 4th, we have FMR with a 3.03% stake, almost double that of Bank of America's. Next is State Street, back in their usual 3rd place with a 4.59% stake. In 2nd, once again, we have BlackRock with a 7.76% stake, not too far behind from Vanguard, who sits in 1st place with an 8.52% stake in Lowe's, equaling around $8.6 billion. I was expecting a higher stake by both Vanguard and BlackRock, but it is quite possible that neither expected the significant rise in Lowe's stock this year. Now, let's look at some risk factors when investing in Lowe's. How quickly Lowe's adapts to rapidly changing environments and consumer spending habits can be detrimental to their business's well-being. It seems that they have figured it out in 2020 given what is happening overall, but changing shopping habits will always be a major risk to them. Also, Lowe's has a whole new management team, and with that always comes risk. New policies and changes take time to implement and may not always work out, though it seems to be thus far. Investors would do well to keep an eye on internal developments at Lowe's. Lastly, their supply chain is also a risk factor. Lowe's sources a large number of products from foreign manufacturers, with China being the dominant import source. Any trade tensions could adversely affect the company. In my opinion, overall, I believe Lowe's is a very solid company. With over 56 years of dividend growth, their dividend king status is more than justified. The company's new management team under Ellison seems very capable and have enacted drastic changes throughout the company, from changing a lot of executives and senior management to closing down underperforming stores. This in turn has no doubt bolstered their balance sheet. Ultimately, I believe these actions will reward Lowe's shareholders in the long run, and thus far has big time in 2020. That being said, taking a look at my holdings, currently I do not have any Lowe's stock. I only own Starbucks and Genuine Parts Company in my dividend portfolio under the consumer cyclical sector. Will I be adding Lowe's next? As of right now, I feel like the company has run up significantly in 2020 and I definitely missed the boat when it was in the $100 range. If there is a pullback near $120, I will strongly consider adding, but I am in no rush with the current $160 price tag. Overall, I'm a big fan of the company and have found myself shopping there more frequently in 2020. That concludes our analysis of Lowe's. Thanks for watching everyone, hope you all enjoyed the video. If you made it thus far, don't forget to like the video and subscribe to support the channel. Till next time, Stock Ninja out. I am not a financial advisor, and this video is for educational purposes only. Please do your own research before buying or selling any stocks seen in this video.